Hello everyone, I hope you all are doing good. Okay, so let's start today's lecture. In the last lesson we talked about liquidity preference theory. So in continuity with that, we are going to discuss about liquidity trap. Now let's see what is this liquidity trap. But before moving ahead with liquidity trap, let's understand that what is the relationship between liquidity trap and the liquidity preference theory. Though we have already discussed it in the last lecture, but let's have a quick review so that you'll get an idea how both the concepts are related. If you talk about liquidity preference theory, it was developed by the renowned economist J.M. Keynes. The liquidity preference theory aims to explain how interest rates are determined. So we have seen that in liquidity preference theory, which we also call as LP theory, where we discuss that how the interest rates are determined, and it was given by a popular renowned economist J.M. Keynes, who is also recognized as the father of macroeconomics. The central premise is that people naturally prefer holding assets in liquid form, meaning they can be quickly converted into cash at minimal cost. The main concern or the main area of discussion was that people prefer to keep money in liquid form. When we say liquid form, what does it mean? Liquid form means where it can be easily convertible into cash at the time of need, so it can be easily convertible into cash. The most liquid asset is money itself, so we already know that the most liquid asset is the money. Now, during economic conditions like recession, where uncertainty prevails, people tend to desire more liquidity. This leads to a higher demand for cash. What happened during the uncertainty or the economic conditions like recession, depression, all these situations, people desire or wish to have more money in cash with them. They would like to keep, like, they should have money with them. They should have cash with them because they never know what the situation are going to be at the next hour. Then, consequently, higher interest rates are required to induce a shift from liquid assets like cash to illiquid assets such as bonds. So what happens when interest rates are high? So there is a shift, like people shift from keeping liquid assets, from keeping liquid assets, they prefer to keep it into or invest it into bonds, which we call it as illiquid assets. The theory, what does it say? That interest rates emerge from the tension between people's desire for liquidity and their willingness to hold less liquid interest earning assets like bond. So here it says that this theory is based on the fact, it emerged from the fact that people would like to keep money in cash with them rather than investing on or putting it on bonds from which they can earn higher interest. But what they do, they prefer keeping it into liquid form. So this is what we studied in liquidity preference theory. Now let's have a look at what is this liquidity trap. Liquidity, you know, that's about that liquidity, that what people prefer to keep money in cash with them, that we call it as liquidity. So a liquidity trap occurs when interest rates are very low, yet consumers and investors prefer to hold cash rather than spend or invest in high yielding bonds or other assets. Here it says that when the interests are very low, so consumers, investors, they prefer keeping money with them. They prefer keeping cash with them rather than spending it on other things or investing it on bonds. What are the key characteristics of liquidity trap? Very low interest rate, inflation, slow or negative economic growth. So these are the characteristics of liquidity trap. In such a scenario, monetary policy becomes ineffective because even if central bank lowers interest rates, people still choose to hold cash rather than engage in spending or investment. This is the time when monetary policy, you know what is monetary policy? Monetary policy is the policy which is devised by the central government to keep a check on the flow of money or to keep a check on the flow of credit in an economy. So it says that during this time, the monetary policy becomes ineffective. Why ineffective? Because even the lowest interest rates, when the interest rates are really low, people still prefer to hold that money, to keep that money with them rather than investing or on any other activity. The liquidity trap concept gained prominence during the Great Depression. So this concept gained recognition during the time of Great Depression. Why? Because the situation, the economic conditions were really tough. So at that point of time, people were very much uncertain about this situation. So they prefer to keep money with them so that in case of any emergency or any requirement, they can utilize that money. Now, let's have a clear definition of what is this liquidity trap. So basically, liquidity trap is a situation where an increase in money supply does not affect the interest rate. Usually what happens that change in the money supply brings about the change in the interest rate, but liquidity trap is a situation when the change in money supply is happening but that does not affect the interest rate. Interest rate is the same but that does not bring about any change in the interest rate remains the same though the change is happening in the money supply. Normally an increase in the money supply which will cause interest rates to fall. This happens, we know that when the money supply increases, interest rate falls, but in liquidity trap this is not happening. However, at a lowest interest rate, liquidity preference becomes perfectly interest elastic and an increase in money supply does not affect the interest rate. So Keynes described this situation as a liquidity trap. Usually what happens that when the money supply increase, it will lead to interest rates to fall. But here this is not happening, though money supply is increasing, but the increase in money supply does not causing any effect on the interest rate. Rather, it becomes perfectly interest elastic. So Keynes described this situation as a liquidity trap. Let's have a look at this diagram. Here you can see that the money supply is increasing from MS0 to MS2. But if you have a look at the interest rate, that is R0, that no matter whatever the change in supply is happening, but the interest rates are the same. With every increase in money supply at the lowest interest rate, the interest rates are same. It is not leading or leaving any effect on the habit of the people that they want to change they want to go ahead with any of the thing or they just change their mindset. No, money supply is increasing but the rate of interest remains the same, which is quite against the thing what actually happens in a normal scenario. But here what happens, if you see that from E0, E1, E2, it becomes perfectly elastic. So this is the time when in spite of having the lowest interest rate, people prefer keeping money or holding money with them rather than investing it or putting it into the market. So this is the condition which we actually call at your liquidity preference. So the curve that you see that starts from the top and then it goes to the E2, that we call it as LP, that is your liquidity preference curve. Now comes the question that why does it happen? Usually this is not a normal condition, but why does it happen that when even the interest rate is so low, but still people prefer to keep with them rather than investing it into any other thing? So there are certain reasons for that. Let's have a look that why people prefer to hold money in spite of increasing money supply but having low interest rates. There are three main factors that you need to know. First is your preference for liquidity. Preference for liquidity means their choice to keep the money in liquid form with them. In a liquidity trap, people and businesses may prefer to hold on to cash rather than invest or spend it, even if interest rates are low. But why? Though money supply is increasing, interest rates are low, but still they prefer to keep with them. But why? This preference for liquidity stems from uncertainty about the future and a desire to have readily available funds to meet any unexpected expenses. This preference for liquidity happens just because of uncertainty, because they were not knowing what is going to happen next. Maybe an emergent requirement came up, or there is a certain emergency for which the money should be readily required. So for these reasons, they prefer to keep money with them rather than investing it into the market. So what happened at the time of an emergency or something, it would not be easy for them to get the money on time. Next, what was their next reason why they prefer to keep money with them at such a low interest rate? Expectation of future rates. Means what they believe that what is the rate today, it may go down or it may increase. So whatever the expectations, they believe that there will be change in the interest rates even if interest rates are low, people may expect them to fall even further in the future. So here they are believing that this low rate is not the lowest. Still, there is a scope that it can go beyond that. In such a scenario, they might choose to hold on to cash rather than invest now and potentially lose out on better opportunities when interest rates decrease further. So they prefer to keep that money with them so that they can utilize it in the right way at the right time rather than depending it on any other source or market. Next factor, it says lack of confidence. In a liquidity trap, economic conditions are often characterized by low consumer confidence and pessimistic expectations. What are pessimistic expectations? These are negative expectations. Like anything can happen negatively that will impact the consumer and the economy about future economic growth. So here it says that the economic conditions there, the consumer can easily see the situations that are actually happening in the economy or in the market. So they are not very sure that what future holds for the economy and what future holds them for them. So this lack of confidence can discourage spending and investment regardless of how much money is injected into the economy or how low interest rates are. So this lack of confidence is actually discouraging them to invest it into any other thing. So they prefer keeping that money with them so that they can utilize it as and when required regardless of dependency on any other aspect. Now, this is about, these were the reasons which mentioned that why people prefer to keep money in liquid form with them rather than keeping it with the banks or either keeping it with other sources. Now let's have a look at the limitations of liquidity preference. First limitation is that people and firms do not hold all their wealth in two ways, cash and bonds. Throughout the liquidity preference theory, we talked about cash liquid assets and we talked about illiquid assets, that is your bonds. But usually if you look around, these are not the two ways only in which money can be secured or can be kept hold of. That cash and bonds are the not only two areas. There is things beyond that, but this theory is restricted only to these two aspects. The financial system in less developed countries is not well established. It says that if you talk about the interest rates, if you talk about the money supply, still in the less developed countries this is not well established. So this theory does not like applies to every aspect or every country. The same interest rate is not charged for all the types of financial assets. Though it says that this interest rate is same, but what happened? The interest rate keeps on changing. And why does interest rate change? It depends upon a number of factors. It depends upon number of market conditions. So all these factors collectively determine the change in the interest rate. So we cannot say that the same interest rate is not like applies to all the type of thing. Okay, so it means that same rate is not at all applied to all the financial assets. So these are some of the limitations which have been posed before this liquidity preference theory. And as we have seen, liquidity preference means the preference of the consumer to keep money in liquid form with them rather than investing it into any other activity or any other event. And when we talk about liquidity trap is the condition where people prefer keeping money with them in spite of having more or increased money supply but lower interest rate. Even in that situation, they prefer to keep money with them at the lowest rate because they were not sure of the uncertainty. They were keeping themselves ready for any type of emergency and they were not having enough confidence in the market and the economy. So for all these reasons just motivate them or force them to keep money with them rather than investing it into the market. So that is all for the liquidity trap. And if you connect it or if you see this video after the liquidity theory, you will find more clarity and you will understand it in a better way, that why liquidity preference of money says what are the reasons for which the money they keep with themselves and why this liquidity trap happens. So when you see both the lectures together, you will get more clarity. In case if you have any more doubt or question with this lecture, let me know, write into me or just comment on the comment box. So I'll just see your responses. Any other topic you would like me to take up, do let me know. I'll be more than happy to help you all. So that's all for the day from my side. Hope you all have a great week ahead. Thank you everyone. Keep shining.